G'day and welcome to Property Australia's favourite obsession. My name's Jeremy Cownan and this is another Quickhits episode. We'll of course be back next week with a full episode of Property Australia's favourite obsession, but today it's all about the banks. See, with fixed rates even lower than variable rates, the question on everyone's lips is, should I fix or stay variable? So who better to talk all things finance than lending specialist Rory Sercombe from Own Home Loans. G'day Rory and welcome to Property Australia's favourite obsession.
Thank you so much, Jeremy. How are you today, mate?
I'm very well, thanks Rory. Hey, let's jump straight into it. Property is absolutely booming. Don't worry about COVID or lockdowns or all these world supply issues. Real estate is on fire, isn't it?
Sure is, mate. We are very, very busy people in the lending game, mate. There's certainly a lot of transactions happening. So, we're sort of absolutely at the tail end of the last release from in Melbourne specifically, and from Sydney of those settlements still coming through. It's probably slowed down a little bit because people can't go and see properties in the sort of, again, just in Melbourne and Sydney, but if you look at other markets around the country, they are still absolutely going crazy.
Well, it certainly hasn't done anything to dampen prices, but I guess the question that is really on everyone's mind is that, are the banks lending and how liberal are they with their credit policies at the moment?
Mate, they are absolutely lending. I think like always, there's the right lender for the right client. So just because one lender's policy don't fit the appetite of a client doesn't mean that the lender down the road isn't going to find a home for that client. So we are finding that it is reasonably loose. There's still they're being responsible about it. I know there's all that stuff about responsible lending and those requirements going, but they still are responsible for who they lend to, and they want to make sure that their book is a good performing book. So they have their markets that they chase and then the niches that they chase. So on balance, you can find a home for a good loan. So the money's flying out the door, mate, and for a good client, we'll definitely find a good loan for them.
It's sort of fitting exactly with what we would expect from a cyclical nature of both the real estate price-wise, but also, of course, the banks with their lending capacity. Because, as you said, the responsible lending requirements have been lifted, but given that we're still in the early stages from a property boom, we would still expect the banks to be, somewhat cautious and a little bit more pragmatic with the deals that come across their desk. But as you said, it's very much about finding the right lender for your lending type.
Spot on, mate. Look, absolutely. So we know that banks really chase, certain banks chase or certain lenders chase a certain sort of business, and they're certainly backing that style of business. And again, mate, it's just finding the right home for the right client. But they still need to act responsibly, but there's also that which I like, a bit of personal responsibility from a client. So it's not just they're not just being so dogmatic about how they're going to look at a file. It's saying, okay, well, look, is this client capable and willing and probably will pay back this loan? Are they a good credit? If they are, lend them the money. So it's kind of swinging back that way, which is, I think, finding a reasonably good balance.
So in our other business, Count and Flack, Raw, we've been saying since 2015, we've been on record as saying that we thought rates would get down to, official interest rates that is, down to 0.25%, which at the time seemed absolutely ridiculous. We're at 0.1 at the moment, which is just an insane official rate, isn't it? It's just ludicrous.
That is the technical term for it, mate. Absolutely, it is insane. Look, you guys, consistently nail these things when most don't. Amazing that you predicted it and you got it pretty much. I mean, between 0.25 and 0.1, it's pretty much spot on. It's fantastic. I didn't think it would get down anywhere near this low, but here we are, and there's because of that, obviously that's a big part of why the property market is still booming along.
So we've encouraged borrowers to stay with variable rates all the way down.
Sure.
And I want to get to that question, fixed or variable rates. What should we do? Where should we be now with our rate outlook? But I guess
Sure.
before we go and get to that question, answer that question, it's important that we think about what the difference is between fixed and variable rates, because it's not just an interest rate differential that we need to be thinking of. There are other implications of being on a fixed or a variable rate product.
Yeah, spot on, mate. So, and that's a really, really important question that people have to answer, and they have to understand what the pros and cons are of fixed and variable, because you're taking a risk either way. So, and like you, I've always been very much pro variable, because the beauty of a variable rate loan is that it's got the most flexibility. It means that that your rate will float up and down, generally with the Reserve Bank, but not always. But generally, they don't have to go up and down with the Reserve Bank, but competitive pressures generally make them do so. So you get the flexibility of that rate. You get the flexibility of being able to pay as much as you want to onto the loan at any time, but the banks have the flexibility, or the lenders have the flexibility of moving your rate up and down as they see fit. With a fixed rate mortgage, it's as the name mentions, it is fixed. It's not going to move. So whatever rate you lock in at the time, that's your rate for the next 1, 2, 3, 5 years, whatever you fix for, which is great, gives you that stability, but that comes at a cost of lack of flexibility. So you can't make a lot of extra payments generally onto that loan. If you do make extra payments onto it, you can't get them back out as a redraw. You can't do things usually like having a fixed rate, having an offset on a fixed rate. So an offset account, is a transactional account that sits next to a home loan, which is a really effective way of saving interest. You usually can't have those on a fixed rate loan, or the ones that allow that generally charge a bit more for it. So you've got to weigh up how much flexibility you need versus what stability you need of your rate. So you've got to ask yourself a few questions at the start to see what's kind of right for you, and it's different for everyone. So what's the likelihood of you selling your property over the next 2-3 years, whatever the fixed rate period is? What's the likelihood of you coming into a significant amount of cash over that rate, over that locked period? So you've got to think about those things and try and forecast forward to see if a fixed rate is right for you. But you can also have the best of both worlds, and this is what we're seeing a lot of clients do, and they'll have part fixed, part variable. So we kind of forecast, okay, over the next, say, 3 years, for argument's sake, we're going to think we can probably pay off an extra 50 grand. So let's make sure we've got that amount free and variable, so you can actually pay down that portion of the loan. So it is very much a personal decision. You've got to look at your own circumstances, but there's vast differences between having a fixed and variable loan.
So apart from the interest rate cost, Rory, is there a difference in cost in having different products or multiple products stacked upon a lending with your loans?
Not really. So you've obviously got different interest rates, but usually there's no extra further costs associated with it. Sometimes to split a loan, you might need to go on to a professional pack or a package with a lender that may have an annual fee, but not all the time. They might charge you a monthly fee per account. So if you've got a fixed loan and a variable loan, there may be extra charges, but that's not always the case. It should form part of the decision of how you if you go fixed variable or do a bit of both. But it's every lender treats it a little bit differently.
And it really is a situation that there's no one size that fits all here, is there? That borrowers need to make these sort of decisions in like when considering their own circumstances as to what they need, what flexibility they do or don't need. Because at the end of the day, being on a fixed rate, it gives you a level of security, but it comes at a cost.
Absolutely, mate. So, look, and it is absolutely one that you can't make the decision quickly. You need to do a little bit of maths, a little bit of forecasting, just to make sure that you're not getting yourself into a situation that's going to cost you a lot of money. Because if you have to break a fixed rate loan, for instance, it can be really, really expensive. If you don't leave enough variable and then you can't make any extra payments, well, you're paying interest, no matter how low that interest rate is, you're paying interest where you don't necessarily have to pay interest if you left a little bit more variable to pay down. So there's some significant costs in and around it. And we do see some people trying to jump in very quickly. So, part of my job is to slow people down and say, let's just go through and let's just have a think about the next few years. Let's do a little bit of maths at the start. And let's get this decision right. So there's lots of ways to cut it up. So we've got some clients at the moment, we're doing part variable, part 2 years fixed, part 3 years fixed, to give that even more flexibility and sort of hedging those bets even more. So there's lots of different ways to skin that cat.
And the question used to be much easier, didn't it, historically, because there was a significant premium that you paid for security of a fixed term loan in essence.
Absolutely. So usually the fixed rate loan was higher than the variable rate loan, and that's flipped now. So we're finding the fixed rates are less than the variable rates, and we know historically that the banks or the lenders would win that bet 75% of the time. So 75% of the time that you fix your rate, you could expect to pay more to the lender than if you kept your rate variable. So it was a much easier decision to say, realistically, probably don't go down that fixed rate path. You're going to pay a premium from day one, plus chances are over the journey, you're going to pay a premium. Now it's it's unusual because you've got the Reserve Bank pumping money into the system, quantitative easing to make especially this the 3-year fixed rate at the moment very, very cheap. So banks can buy that money really cheap. They can put it out really cheaply, and obviously that's by design to keep the money moving through the economy. So you've got these really cheap fixed rates. So it's very hard it's much easier to make the argument, I should say, to fix at least a part of a rate. And that's what we're seeing with a lot of our clients.
And what are we sort of looking with regards to the differential between the fixed and variable rates at the moment in broad brush terms? Right?
So broad brush, you're looking at, say, for a standard owner occupied home with with 20% equity, so an 80% loan or a 70% loan around that sort of mark, you're looking at high ones for a fixed rate. So, you might have a 1.8-ish up to sort of 2% in that sort of range. And for your variable, around the sort of 2.4, 2.5s. But, there's obviously a fair bit of play in all that, and depending on the lender, but they're the kind of rates that we're doing pretty consistently at the moment. So if you start your journey off and you've got, say, half of your loan fixed away at, sub 2%, it's pretty hard to lose. I can't really see how you can really lose as long as you leave enough variable. I don't know how you can lose, because it's going to take that variable rate to drop below that fixed rate that you've locked in before you start losing. And I just don't, mate. You know better than I would on this one. I just don't know how that could happen. I just don't know if there's enough fat in the variable rate market to allow that to ever happen.
It's getting harder and harder to see that occurring. I mean, a 0.5% differential, and as you said, with fixed rates under 2, yep. It does really make you stop and think as you said, we've never been supporters or proponents of fixing your rate because of, as you said, 99% of the time the bank will always win that bet. But at this point in the rate cycle, given the interest rate differential, I think it's something that is definitely something that you need to stop and consider. You definitely need to think about it, because you can be saving yourself significant amounts of money, and especially too for those people who haven't reviewed their loan in the last couple of years. We know that the banks are brutal It's one of the few industries that actually penalises the loyalty of customers. The longer you're with a bank, the further you fall onto their back book, the higher the rate you'll pay compared to the marketplace. And if you do end up on that back book at a higher rate, they will just continue to gouge for as long as they can. We cannot encourage people enough to get out there and review your loans. In fact, the consumer watchdog has actually come out, I think it was late last year, and said basically that all borrowers should be reviewing their loans every couple of years because of this issue with borrowers falling onto the loans at the bank's back books and getting gouged on interest rates.
Spot on, mate. We obviously we see that all day, every day. We have a policy of going back to our clients' lenders once a year to ask for a discount, because we know that if they're not asked, banks will not give a discount, and we know that most people don't ask. So we sort of take that responsibility to try and do that. And it's just a phone call or an email, and you'd be amazed at how much that can actually work to get you a discount. The other thing that we're finding at the moment, which is kind of refreshing, there are a couple of lenders like 86400, which is a lender that we're that's actually NAB's just recently bought, and we're doing a few loans with them at the moment, because one of their things that they go to market with is that they will match the front book price for any back book client automatically. So that's really refreshing.
Do you want to make that really clear to listeners? What does that actually mean, that they'll match the front book price of any back book clients? What does that actually mean?
So if you get a home loan with them today, and let's say this isn't the rate payment, let's say it's 2.5% for argument's sake, and then down the track, that variable rate, only on variable rates, because obviously fixed rates, you get fixed in, you get locked in. But if they are starting to get new clients at a cheaper rate than you're on, they will put your rate as an existing customer onto that rate that they're offering for new customers. And that's a really refreshing new thing that they're doing. So we're backing them, and I'm hoping that they back their clients and their actions match their rhetoric. And if we've got a client who they could have got a cheaper rate as a new customer, well, they should instantly, automatically match that rate for an existing client.
So this is really interesting, isn't it? Because what you're basically saying there is, if I get a loan with them, as you said, it's say 2.5%, and the variable rate reduces, or what they're offering what they're offering new customers. So the variable rate doesn't necessarily change, but what they're offering new customers is now say 2.2. Then they'll immediately bring the rate back down to 2.2 in accordance with what the new customers are paying.
That's right. Now we're not new at this game, and we understand that there are some lenders who might, bring out new products to get them, out of having to honour that in the future. So I'm not in any way suggesting that 8600 would do this, but there have been the lenders who bring out new products to sort of hide back book and front book pricing, and we've seen that in the past, and we'll be keeping a very keen eye on these products and others who promise the same thing, to make sure that this doesn't happen to any of our clients.
Raw, let's wrap it up there. It's certainly some food for thought, given the fact that not only rates are being so low, but we've got variable rates above fixed term rates at the moment, at very, very low levels. And of course, we've got that differential of people, who haven't reviewed their loans ending up on higher rates again. It's definitely something that we would draw your attention to, definitely something that's worth shopping around. And I guess it's another reason why it just now does not make sense to just go straight back to your bank, to accept what's on offer there. That the market's very competitive. As you said, the lenders are becoming more and more open to the creation of credit and the level of lending that they're creating, and that's really important. That's what we would expect as the boom really starts to get underway. So definitely time to pick up the phone and review what you've got and have a think about your circumstances as to whether you want to borrow some more money for investment purposes.
Absolutely, mate. Indeed, it's a great time to do it, mate. I think that most people we're talking to, they're saving money, even just by just knowing what's out there in the market and going back to their to their current lender. So good time to put some money back in your pocket rather than donating it to the banks, that's for sure.
Raw, how do people get in touch with you?
Mate, probably in the website's best. If it's just all the W's at ownhomeloans.com.au, all our contact details are there.
So let's wrap it up there for this episode. If you've got any questions regarding your property or investment needs, we'd love to be assistance. Just head to pafo.com.au. I'm, of course, Jeremy at pafo.com.au. And you can catch us on the socials, Facebook, Insta, and, of course, Twitter. Just have a look for the handle PAFOPod, so PAFOPOD. And don't forget, if you like this show, tell your friends about it and make sure you're leaving us a rating and review. It's always fun, Raw. Thanks for listening, everyone. And until next time, let's keep obsessing about property.
Any opinions or recommendations expressed should be considered general in nature, as they do not consider your personal objectives or financial circumstances. You should therefore consider these matters yourself before deciding whether the advice is appropriate to you and if you should act upon it. Should advice be sought, please seek an appropriately qualified advisor. Investing may not be appropriate for everyone, as there is inherent risk and the possibility of loss when investing in financial assets, just as there is the possibility of profits. While useful for identifying patterns, history and past performance do not guarantee future performance. Calvin & Flack has a commercial relationship with guests appearing on this production.